Hello, very good afternoon to all, and welcome to today's Daily Dose of Market Insights. My apologies for the initial hiccups on the voice recording. So this will be an proper recording for today's Daily Dose of Market Insights. So I hope that you guys have a restful weekend. And today will be Monday, the 2nd of December 2024. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's have a recap what has taken shape on last Friday and as well as over the weekend in terms of the intraday performance of the broad-based cross asset classes and as well as key economic data that impact this movement of these broad-based cross asset classes. So let's start with last Friday. So we know that last Friday was actually a shortened US session due to the day after Thanksgiving, which is on last Thursday, where on last Friday, all the US stock exchanges closes for half day. But that nevertheless causes a positive feedback loop into the major US stock indices, where all the four major stock US indices, as you could see on my screen over here, close in the green, where the SPX is up 0.56%, the Nasdaq 100 up 0.9%, the Dow Jones up 0.42%, and the Russell 2000 up 0.35%. And also last Friday, interestingly, is the last business day for the month of November. So let's take a look at the monthly performance, how these four major stock indices perform. So this major monthly performance on the four major stock indices continue to see the outperformance of the Russell 2000 and the Dow Jones Industrial Average. So for those who followed my daily dose on a frequent basis, I've been emphasizing this potential outperformance of these two much more localized, highly sensitive US economy centric Russell 2000, the small cap, and the Dow Jones Industrial Average that potentially has starts to build up a medium-term outperformance against the internationally driven mega cap centric SPX 500 and the Nasdaq 100 due to the American first policy that is likely to be undertaken by the incoming Trump administration starting early next year. So the Russell 2000 small cap index closed out December with a monthly gain of double digit of 10.84%, and the Dow Jones Industrial Average has a monthly November gain of 7.54% that clearly outperformed the international centric and the mega cap heavily weighted SPX 500, which is only up 5.7%, and almost on a similar magnitude, which is the Nasdaq 100 is up by 5.23%. So very clearly, we see the continuation of the outperformance of the US heavily localized economic sensitivity centric Russell 2000 and the Dow Jones Industrial Average benefiting from the American first policy that is soon to be undertaken by the incoming Trump administration. Right, and also on last Friday, we do highlight there could be a return of dollar strength coming back into the picture because of the technical configuration on the major US dollar pair. And very interestingly, on the news flow over the weekend also supports this potential resurgence of dollar strength coming back into FX market is due to another potential, we call it a tariff trade tantrum uh, invoked by Trump over the weekend, where he actually threatened BRICS. All right, over here, we know that BRICS is being formed as an alternative commodity or economic bloc to reduce the reliance of US dollar usage for international settlement of for international trade. And BRICS itself is the key, we call it anchor of BRICS are Brazil, Russia, and China. And recently, the members of the BRICS decided to actually form another kind of hard currency that's involving the yuan as an alternative to dollar for international trade settlement. And because of this, Trump evoke another trade tariff threat over the weekend, stating that if the BRICS member were to ditch dollar as an international invoicing currency, he would threaten any BRICS member that does that with 100% trade tariffs on that. All right, and also over the weekend, we start to see a bit of political instability coming back into the French economy. So we know that this summer France has a snap election. So after the second round of the France snap election, the parliament is a hung parliament. No key political party managed to gain a cornerstone in terms of power. So it's more like a power sharing. So over the weekend, far right leader Le Pen has threatened to invoke a no confidence vote this week to actually potentially remove the current French premier. All right, so that potentially could also see an uptick in political instability risk factor in the French economy. And we know that the France is a anchor Eurozone member that could potentially see a bit of downside pressure being inflicted on the Eurozone currency. So net overall, based on these two positive news flow that is supporting the US dollar strength coming back to the FX market, we start to see a resurgence of dollar strength coming back into the picture, where we start to plot the 5-day rolling performance against the dollar against the major currency as we are speaking right now. So okay, we see a slight uptick. So the dollar now is strengthening against the CNH, the CAD, the Aussie as well. All right, and still lagging behind the Kiwi and the sterling dollar, but more or less we start to see an uptick. And most importantly, the previous yen strength has starts to see a bit of mean reversion reversal by the dollars against the Japanese yen. So a bit of we call it pullback of the yen strength that is being seen last week as well. Right, so later I'll touch on more of the short-term intraday technical outlook on the dollar yen and the other major currency pair against the dollar. So one more news I'll highlight over here is more pertaining to the Chinese economy. So over the weekend, we do see the release of the official MBS manufacturing PMI and the official non-manufacturing PMI that covers the services sector. So we see a mixed bag performance. The manufacturing PMI almost on par with consensus. So market is expecting a 50.3, slightly incremental increase from 50.1 that was recorded in the month of October. So it came in for November, it came in within expectation of 50.3. But however, the non-manufacturing PMI, which covers the services sector, underperformed. 50 at the break-even mark over here. Market is expecting 50.2, but it came in below than what market is expecting, and also below the previous month of October reading of 50.2. And as well, on Saturday, there was also a release of a privately we call it a compound housing data pertaining to the value of new home sales from the 100 biggest real estate company in China, compiled by this China Real Estate Information Corporation, that saw a 6.9% year-on-year sales value drop year-on-year in the month of November, erasing earlier 7.1% year-on-year gain that was recorded in October. So we start to see a lackluster year-on-year annualized sales figure for new home sales that's being compiled by this privately we call it agency, which is the China Real Estate Information Corporation, based on the sales reporting figure from the 100 biggest real estate company in China. So net overall, it seems to us that the Chinese economy is still facing the risk of a deflation risk spiral, but more more related to the ongoing lackluster environment being depicted by the China real estate market. That means indicating that whatever piecemeal fiscal stimulus policy that's being enacted currently by China policy makers is insufficient to defeat this potential deflationary risk spiral that is coming out from the Chinese economy. And that also causes the Hang Seng Index and the benchmark China stock indices to erase earlier gains that is being seen at the start of today's Asia session. Later, I'll touch on more on the short-term intraday technical outlook on the on this we call it Hang Seng index over here. So with that, now let me share with you guys one intermarket dynamics pertaining to the euro dollar that could impact from a medium term, i.e. multi-week perspective, is regarding this ongoing political instability that is coming out from the French economy. So what you could see the top of this chart over here is the push up of the yield spread premium between the 10-year France sovereign bond against the 10-year German sovereign bond. So this push up in the yield spread premium, it actually did a bullish breakout. So this bullish breakout is being a kind of a sideways symmetrical triangle range configuration that is in place since the low 10 years ago in July 2024, and recently it did a bullish breakout in June 2024 in line with the outcome of the French snap election. And whatever happens over this coming week, where we could potentially see a no confidence vote that's being played out, uh, ignited by the far right party leader Le Pen against the current incumbent French Prime Minister. So if the French Prime Minister were to be forced to step down, potentially this yield spread premium over the France sovereign bond against the 10-year German sovereign bond will potentially continue to inch upwards towards the next medium-term resistance at 0.98%. And ever since we've seen this push up in the yield spread premium, it actually increases the credit risk of holding on to French sovereign bond yield sovereign bonds. And we know that the France economy is the one of the anchor economy of the eurozone, other than the Germany economy. Increase in credit risk of France sovereign bond potentially could inflict downside pressure on the euro currency as well. So what you could see over here is that this push up in the France sovereign bond yield spread premium against the 10-year German sovereign bond, indicating an increase of credit risk holding on to French sovereign bonds. We see the euro dollar starts to tick downwards as well. All right, and most importantly, the higher sensitivity euro Swiss cross pair, which is being used as a macro team play to take part in this potential increased risk in the French economy, political risk, which could also potentially lead to a wider political risk being played out in the eurozone economy as well. Saw the euro Swiss rate retesting its 2024 low, which is a multi-decade low over here. All right, so it seems to be inching and forming another potential major low that is could major lower low that could take shape on the euro Swiss cross pair, because it's a much more of a risk of sensitivity play by macro traders or macro hedge funds to actually take advantage of this heightened increase in credit risk in the French sovereign bond, which potentially could lead to a higher political risk premium on holding on to eurozone risk asset classes that eventually potentially see a further downside pressure on the euro Swiss FX cross pair. All right, so now with that, that is the key intermarket dynamics that I'll share with you all for today, pertaining more to the euro currency, arising from this not so favorable political climate in the French economy that is being playing out right now. All right, so with that, let us now deep dive into much more of a shorter term intraday technical outlook on the major cross asset classes. All right, so before that, let me expand my screen so that you guys could have a better view of the chart itself over here. So now let's start with the FX market first. All right, so starting with the euro dollar. So if you recall on the euro dollar on last Friday, we do have a bearish bias, stating that whatever's at the start of last week is more like a dead cat bounce, as the euro dollar trade within this bearish flag formation since the low of 22nd of November. So this bearish flag formation in today's Asia session has already triggered a bearish breakdown by the break of this lower limit of the bearish flag formation. So with that, we will have a tightened key short-term pivotal resistance for today at 1.06 64.10 as my short-term pivotal resistance level. Next near-term support level to watch out for will be 1.0410. A breakdown below it, revisit the 22nd of November minus swing low at 1.0330. But however, if price action have an hourly close above the Titan key short-term pivotal resistance for today at 1.0610, will invalidate today's intraday bearish bias to see the continuation of the mean reversion rebound to extend towards the next near-term resistance zone of 1.0660 slash 1.0680. Above it sees 1.0770 next potentially as well, which confluence with the downward sloping 50-day moving average and the key 200-day moving average that's confluencing very closely with the 1.0770 next resistance level to watch. Right now, turning our attention will be the sterling dollar. So the sterling dollar also shaped a bearish reaction of the 20-day moving average, which is very close to our 1.2750 short-term pivotal resistance that we highlighted on Friday as well. So still no change, still using 1.2750 as my short-term pivotal resistance, still maintaining that intraday bearish bias on the sterling dollar. First near-term support zone to watch out for will be 1.2610 slash 1.2580 for today, which confluence with the minor upward sloping trend line that is in place since 22nd of November minus swing low. Only a push up and an hourly close above 1.2750 will invalidate today's intraday bearish bias to see the continuation of this mean reversion rebound extending towards the next near-term resistance zone on the sterling dollar at 1.2840, which close to the 200-day moving average. Above it exposes 1.2960 next intermediate resistance to watch out for, which is also confluencing with the downward sloping 50-day moving average as well. All right, so with that, let us now turn our attention to the major Asia Pacific currency against the dollar, starting with the Aussie dollar. So still recall Aussie dollar on last Friday, we do have a bearish bias below 65.45, which also correspond very closely to the downward sloping 20-day moving average. Prices almost came close on last Friday and did a bearish reaction of it. So still no change, still using 65.45 as my key short-term pivotal resistance on the Aussie dollar, still maintaining that intraday bearish bias. But with first near-term support to look out for will be at the 64.80 level mark. So this 64.80 level mark will be a near-term support, important support level to watch. Why? Because it also corresponds to the minor ascending trend line that managed to help previous sell-off since the low of 26th of November 2024, which was last Tuesday. Only a clear breakdown below 64.80 potentially will reinforce that intraday bearish bias to expose the next support level at 64.10, which is the upper limit of a major support zone for the Aussie dollar. Only an hourly close above 65.45 for today will invalidate today's intraday bearish bias to see the extension of this mean reversion rebound scenario unfolding, exposing the next intermediate resistance levels to watch out for. After 65.45 will be 66 figure, followed by 66.40 next, which is key. Why? Because it corresponds to the 200-day moving average and as well as the 50-day downward sloping moving average as well. Right, so now turning our attention will be the dollar yen. All right, so dollar yen on last Friday we do have a bearish bias. So the bearish bias almost came close to the support zone that we were highlighted earlier on at 14930 slash 14885. So this dollar yen over here is very interesting in terms of fundamental factors. Is being oppositely put by number one, dollar strength, and also on trade tariff tension or threat that's being invoked by Trump incoming administration that could also see some signs of yen strength coming back into the picture as well. So from a technical perspective over here, what we could see over here is that price action on last Friday hit the lower limit of this minor downward descending channel that I drew from the high of 20th of November, and we start to see a bullish divergence that's being played out on the hourly RSI. So with that, that could be some form of mean reversion rebound, at least on the intraday basis on the dollar yen. So using 14930 slash 14885 as my short-term pivotal support zone for today, we will flip to a intraday bullish bias on the dollar yen for this potential intraday mean reversion rebound above 150.60 exposes the mean reversion rebound resistance zone to look out for in first step at 15190 slash 15215. We also correspond to the 200-day moving average. Only a push down and hourly close below 14885 will invalidate today's potential mean reversion intraday rebound scenario to see the continuation of the impulsive down move to expose the next support level at 14725 on the dollar yen. Now, with that, that sum up the intraday technical outlook on the major dollar pair. So let us now focus on the major stock indices, starting with the Asia Pacific stock indices with the Hong Kong 33. So still recall the Hong Kong 33 on last Friday, we do have 19,880 as my short-term pivotal resistance, which correspond to the downward sloping 20-day moving average as well. So price action also failed to break above this 20-day moving average in today's Asia session, and right now as we are speaking is trying to actually trade in that minor congestion zone. All right, so with this still using 19,880 as my short-term pivotal resistance level, still maintain that intraday bearish bias, but within this congestion zone that is being played out since last Monday. First congestion zone support congestion support level to watch will be 19,300. Below it sees the lower limit of that congestion zone, minor congestion zone at 19,080. Only a breakdown below 19,080 will potentially see a bearish breakdown from this minor congestion area to expose the next near-term support level at 18,740 in the first step. However, if price action managed to have an hourly close above the short-term pivotal resistance at 19,880, that would invalidate today's intraday bearish bias to see the continuation of that push up towards the next near-term resistance level at 20,150, followed by 20,490 next. So that's for the Hong Kong 33. Turning our attention will be the Japan 225. So the Japan 225 continues to be trapped within this complex sideways range configuration since the low of 25th of October this year. All right, over here. So right now, price action continues to do a inch back up again towards the short-term pivotal resistance zone that we highlighted on last Friday at 38,670 slash 38,830. So this will be still used as my short-term pivotal resistance level. As long as this level didn't surpass to the upside, we'll still maintain that intraday bearish bias. First support level to watch out for will be today's intraday low over here. Okay, let me put it in writing again. At 37,990. A push down below 37,990 exposes 37,765 next. Only an hourly close above 38,830 will invalidate today's intraday bearish bias within its complex sideways range configuration to see a potential push up towards the upper limit of this complex sideways range configuration, with the next intermediate resistance coming in at 39,090 and even 39,550 in the first step. So that's for the Japan 225, i.e. the Nikkei 225. Now, turning our attention very interestingly will be the German 30. So the German 30 last Friday invalidate our bearish bias within its complex sideways range configuration below the current all-time high level that was printed on 17th of October at 19,690. So price action managed to stage a bullish breakout, okay, above this minor descending trend line that I drew from this current all-time from the high of 29th of October. So with this bullish breakout in place over here, it seems that market participants has now have a bullish sentiment, at least on a short-term basis on the German 30 DAX, in favoring of much more higher magnitude of interest rate cut that could be embarked by ECB going forward. All right, so with that, we will flip to a intraday bullish bias respecting last Friday bullish breakout of this minor descending trend line using 19,405, 19,450 as my short-term pivotal support level. So as long as any pullback managed to hold above 19,405, 19,405 short-term pivotal okay, in fact, let me put it in writing. Should be 19,450. Okay, let me set it in a better way. Okay, 19,450. So as long as any pullback managed to held above 19,450 short-term pivotal support, we will flip to a intraday bullish bias on the German 30 above the current all-time high level at 19,690, which managed to almost come close to it on last Friday. Will potentially see the next intermediate resistance coming in as defined by the Fibo extension level of 0.382 and 1.236 from different degree at 19,840/19,920. Only an hourly close below 19,450 will deem this as a failure bullish breakout on last Friday to see price action of the German 30 invalidating today's intraday bullish bias to reintegrate back into the complex range configuration, exposing the next near-term support level at 19,285, which correspond to the rising 50-day and the 20-day moving average. Below it sees last week low at 19,155 next. All right, so that's for the German 30. Now, turning our attention will be the US Wall Street 30. So the US Wall Street 30, the Dow Jones Industrial Average, which is the US Wall Street 30, managed to hit our first resistance level at 45,070 before shaping a pullback into today's Asia session. So still no change, still using 44,520 as my short-term pivotal support level. Below the first support level at 44,730 because I don't want to put it so tight just in case of any whipsaw. So as long as any pullback managed to hold above 44,520 short-term pivotal support level, we will still maintain that intraday bullish bias on the US Wall Street 30. Above 45,070 sees the next intermediate resistance coming in at 45,450, which is close to this upper limit of this turquoise green line here, which is the major ascending channel from the low of March 2020. Only an hourly close below 44,520 will invalidate today's intraday bullish bias to see another round of minor pullback scenario unfolding on the US Wall Street 30 to expose the next near-term support zone at 43,980/43,807, which correspond to the rising 20-day moving average. Now, turning our attention will be the Nasdaq 100. So the Nasdaq 100 on last Friday, because of a very shorter US trading session, we have a neutrality stance. So price action indeed hit the upper limit of the neutrality stance at 20,990, almost close to it before shaping that pullback over here. All right, and what's interesting over here is start to see a series of higher low after a retest on the 20-day moving average, and the hourly RSI continues to shape higher low as well. No clear signs of a kind of a bearish momentum that is coming back into the picture, and most importantly, the pullback line on last Friday managed to shape this kind of former bearish bullish breakout over here, tested and did a higher low right at this pullback, parallel pullback support line. So given the potential bullish momentum, at least the short term coming back into the Nasdaq 100 as depicted on its latest price action right now, we will use the first support level to look out for today's session at 20,790. But using last week minor swing low area that confluence with the low of the previous Friday, which is being supported at 20,640. So I'll use a slightly lower level below the 20-day moving average that's acting as a support at 20,790, just in case of any whipsaw. 20,640 as my short-term pivotal support level, as well as any pullback that may take shape today that hold above 20,640 short-term pivotal support level. We will flip to an intraday bullish bias on the Nasdaq 100 above 20,990, revisit the current all-time high area at 21,220 next. Only an hourly close below 20,640 will invalidate today's bullish bias to see the start of another minor corrective pullback scenario unfolding to expose the next near-term support zone at 20,460/20,335, which correspond to the rising 50-day moving average as well. So that sum up the intraday technical outlook on the major stock indices. Now let us focus our attention now to the commodity market, starting with gold XAU/USD. So if you still recall, gold XAU/USD last Friday, we viewed the initial push up in during Asia session is more of a liquidity driven push rather than a change in the fundamental. And we also highlight that gold price may be still in the process of a multi-week corrective pullback, where that has taken shape since the current all-time high of 30th of October. So price indeed shaped that bearish reaction of that excess 2666 short-term pivotal resistance that we highlighted on last Friday. So with that, we will still maintain our intraday bearish bias on Gold XAU/USD for today. Next near-term support level to watch will be at 2600 slash 2590. Only a breakdown below 2590 potentially could trigger a further downside pressure on Gold XAU/USD to expose the next near-term support zone at 2546 slash 2526. However, if price action managed to do a bullish reversal above 2666 short-term pivotal resistance with an hourly close above it, today's intraday bearish bias will be invalidated on Gold XAU/USD to see a push up to expose the next intermediate resistance level at 2689 and even 2728/2715. Okay, lastly will be the West Texas crude oil. So for West Texas crude oil, no change as price action continues to remain lackluster below the 20-day moving average and the 50-day moving average as well. So with that, I'll be using the first resistance level to watch will be the 20-day moving average. So that was the high form on last Friday before the sell off at 69.80, but still using 70.80 as my short-term pivotal resistance just in case of any whipsaw for today. Still maintaining that intraday bearish bias on this WTI crude oil, West Texas oil. Next support level to watch on a short-term basis will be 67.55/10. A breakdown below it exposes the lower limit of the major range descending triangle range support level at 65.70. So what's this 65.70? If you look at the daily chart over here, okay, it's the lower limit of this major descending triangle range configuration that is seen on the daily chart since the low of March 2023. So that's on the daily chart on West Texas oil. But however, if for today we start to see a breakout above 70.80 with an hourly close above it, that means breaking out above the 50-day moving average as well, that will invalidate today's intraday bearish bias on the West Texas oil to see a push up towards the upper limit of the upper half of that major descending range triangle configuration, exposing the next intermediate resistance in first step at 71.80, followed by 73.15, where price action come break above it since 24th of October. So that sum up the intraday technical outlook on the major cross asset classes as well. So before we go, let's take a quick look at the economic calendar for today of what are the key data to look out for during the European session. So during the European session, there is not much of a key data except for ECB President Lagarde's speech will be out at 6 p.m. Singapore time today, followed by the same time, which is Eurozone unemployment rate for October. And thereafter, during the US session, one important data to take note of will be ISM manufacturing PMI out at 11 p.m. Singapore time, and its various subcomponent, especially the unemployment subcomponent, indicating the health of the labor market in the manufacturing sector in the US, something to monitor as well. And thereafter will be a slew of Federal Reserve officials speaking in early Asia session at 4:15 a.m. and 5:30 a.m., which is Fed Wheeler and Fed Williams speech. All right, so that's early tomorrow Asia session. So with that, that sum up today's daily dose of market insights. I'm Kelvin here signing off, and we shall speak again tomorrow. Thank you.